Good morning, everyone. Welcome to CRI's Tax Tactics, our 2025 year-end tax planning for you and your family. Appreciate you taking time out of your day to join the CRI team here and talk about some year-end tax planning topics. Before we get started, let's cover the presenters today. First is Blair Wagner. She got her master's from Mississippi State University. In her free time, she enjoys fitness and reading, as well as cheering on her sons playing their various sports. Interesting fact is she lives on a cattle farm with lots of various pets. Also presenting is myself. I'm Chris Hoffman, the tax service line leader for CRI. I got my master's degree from the University of Tennessee. I enjoy watching my hometown teams, the Tennessee Titans, and my alma mater, the Volunteers. I have been traveling to Europe the last two summers, Greece this past summer, and Italy the summer before that. And at home, I have two Boston Terriers, Dash and Winston, to keep me company. Last but not least, we have Ryan Hayden. He got his bachelor's from the University of South Florida. His hobbies include golfing, fishing, and hiking, as well as traveling to the mountains and lakes. And at home, he has his English Springer Spaniel, Lainey. We'll cover a few housekeeping items before we kick things off. First, any information discussed during this course or by the presenters should be applied in a manner consistent with the context within this presentation and the presenters. For those looking for continuing professional education, this course does qualify for 1 hour of CPE. In order to get that CPE credit, you need to be logged in to your own unique Zoom link. You have to be logged in for at least 50 minutes and answer at least 3 of 4 polling questions. If you have any questions about CPE, you can email the email address here, cpe@criadv.com. The PDF of the presentation slides are available in the chat. So if you'd like a PDF copy to go through on your own, please feel free to go into the chat and download those slides directly. So what are we going to cover today? With tax law changing, especially with the summer, we had a major tax bill pass. New federal legislation is really changing how we're doing year-end tax planning. It's adding new dynamics that we're going to cover today. So the 2025 year-end tax planning webinar is here to help you through critical tax law updates, highlight your own planning strategies, and offer practical insights as you think through things that will impact your 2025 tax liability. Our learning objectives is to cover that major bill I referred to before, the One Big Beautiful Bill Act. We're going to cover some year-end strategies, some tried and true strategies, as well as some new things we need to be thinking about due to the tax law changes. We're going to cover some new thresholds and deductions that change each year, and then discuss some proactive steps you can take to reduce your 2025 taxes and things you should be thinking about as 2026 quickly approaches. So specifically, we're going to start out covering those One Big Beautiful Bill key law changes. We're going to discuss what's here to stay, those permanent extensions within the bill, as well as some temporary changes, some still sunset. So we're going to cover some of those. We're going to cover what credits are available, tax credits, as well as what credits used to be available but are either now have ended or will be ending. We will then cover some estate and gift tax topics and wrap up with some key takeaways and planning opportunities. So with that, I will pass it off to Blair to get us started.
Great. Thanks, Chris. I appreciate it. I'm glad to be with you guys today. Looking on the slide, this just kind of highlights some of the key tax changes you're going to see. The One Big Beautiful Bill Act. I'm going to call it OB3A going forward. It tends to be a bit of a tongue twister otherwise. That was signed into law on the 4th of July this year, and it's a major milestone in U.S. tax reform. This is comprehensive tax legislation. It extends and enhances a lot of those key provisions from the 2017 Tax Cuts and Jobs Act that were previously scheduled to expire, had some legislation not taken place there. We haven't seen changes this big to discuss in a year-end update in several years. So our focus today is going to be around this bill and how it impacts you. Ryan, do you want to jump in and talk about some of the permanent changes we're going to see?
I would love to. Well, it's great to be with you all this morning. And as Blair already alluded to, this new OB3 bill, a lot of what it does is it sets to extend what was already in place by TCJA. That's the Tax Cuts and Jobs Act that was introduced in 2017. But it also provided a lot of enhancements. So as we go through this, recognize that the term permanent is relative. So it's only permanent until the next administration comes in and writes new tax law. So through the context of these changes that we're talking about now, yes, they are permanent, but they are subject to change, of course. We'll talk about all of these in great detail, but we're going to touch on the tax brackets, where we're at for 25 and where we will be beyond. We'll talk about the enhanced standard deduction, which will continue to help many taxpayers. The AMT exemption we'll touch on, cash contribution limitations, which was made permanent, the piece limitation, and an item that was permanently repealed. It was set to come back in 2026. And then the estate and gift tax. And that's a hot topic that we'll definitely elaborate more on as we get into the presentation. I think it's been a hot topic amongst all of our clients, their practitioners, attorneys, etc. So getting into the 2025 tax brackets, again, these have now been made permanent. They were set to expire at the end of 12/31/25. We would have seen that highest income tax bracket of 37% come back to 39.6%. This tax bracket system has 7 brackets. It's a tiered structure. You will see that across the various filing statuses, that they really move in conjunction with each other up until you get to the 35% bracket. So the marriage penalty, as it was once termed, is largely minimized up until you get into those higher 2 income tax brackets.
Ryan, something to think about here to consider is that net investment income tax, that 3.8% is still in place. So you could still be looking at a maximum tax rate as high as 40.8% for those higher tax bracket taxpayers.
Yeah, that's a great point, Blair. And to add to that too, this is just a planning opportunity. So the 3.8% net investment income tax, be mindful in years where you may have a liquidity event, you're selling a closely held business that you were involved in where you materially participated. When you sell a business interest, a pass-through into, so a partnership or S corp, make sure that you're aware that that 3.8% does not apply in those situations. More often than not, shouldn't say more often than not, but in situations we found new prospects come to us where there was a sale of a business and the gain on that sale was subjected to that 3.8%. So be very mindful of that. Just a key planning point there. So next, we're going to talk about the standard deduction. Again, this was set to expire in 2025. It would have peeled back to $8,300 for single filers, $16,000 for married couples. So for 2025 and years going forward, this is a permanent standard deduction. What this means is we will likely see the continued trend of more people just taking the standard deduction as opposed to itemizing their deductions. There will be some changes that may allow others to itemize, whereas in years past, from 2017 on, they may not have been. But in large part, I think we'll continue to see a lot of taxpayers taking advantage of this higher standard deduction. One thing to note here too, it's not referenced in the filing status, but it's important to remember if you lose a spouse and there is another filing status referred to as a surviving spouse. So if you have a qualified child dependent living at home, you've not remarried, and you're maintaining more than one half the cost of that home, it's important that for 2 years following the death of your spouse, you will qualify for that higher joint filing standard deduction. So just be mindful of that. Next, this is just a great slide to sort of represent from the tax bracket perspective that we've already discussed in the standard deductions of where we were, where we would be in 2026 had this OB3 bill not passed. And again, we've touched on it, but the 37% bracket could have gone to 39.6. When you add in the net investment income tax, that could have taken you up to a near 43, 44% tax rate. So this OB3 bill was very taxpayer friendly in that regard. And then again, we won't nail on it too much, but the standard deduction, we touched on it. It's a permanent extension where married filing joint couples will be at 31,500. So again, a lot less in terms of those who may be itemizing. The personal exemptions were set to come back in 2026. These were exemptions for yourself or for dependents. They're permanently repealed. And of course, that makes sense with the standard deduction making up for that exemption being repealed. So that takes us to our first poll question.
Okay, thanks, Ryan. First polling question, what is the highest individual income tax rate for 2025? Is it 40%, 39.6%, 37%, or 40.8%? Give everyone a few moments to respond to that. One housekeeping item I wanted to mention, forgot to at the onset, is if questions do arise during the presentation, feel free to enter those into the question and answer section, the Q&A section of the Zoom platform. Time permitting, we will try to answer as many of those questions that come in as possible. So feel free to use that Q&A function in Zoom. We had one question come in on charitable donations, and we will be covering charitable donations here in the next couple of slides. So I'm going to table that question because I think we will cover it here shortly. So with that, let's go ahead and look at those poll results. 70% said 37%, 14% said 40.8. Ryan, can you clarify that for people?
It sounds like we have some pretty educated taxpayers on the webinar with us today. The correct answer was 37%. This is sort of a trick question because we did reference that 3.8% net investment income tax. That, of course, would come into play for higher income earners where they have net investment income that would be subject to that tax. But the answer we were looking for here was 37%. So the vast majority hit it on the head. All right. And with that, I think we're going to turn it over to Blair to talk about the alternative minimum tax changes.
Great, thanks, Ryan. So just high level overview on AMT. I know most taxpayers just know they don't want to be in AMT, but you're basically, what this is trying to do is force high income individuals just to pay a minimum level of tax. So you take the regular tax calculation, you back out some deductions. Some of those more common ones are the standard deduction, the state and local tax deduction, specified private activity bond interest. Those are just to name a few of the most common that you see. And then the tax is recalculated for the alternative minimum tax. With all legislation, we take the good with the bad. The pro of this change is that the higher exemptions under TCJA were made permanent. However, the exemption phase-out thresholds were lowered. So what you're going to see is a faster phase-out rate. Once a taxpayer's income reaches the new lower threshold, their AMT exemption is reduced at a quicker rate. The phase-out does double from 25% to 50% of every dollar of income above that threshold. So you do have a broader reach for high earners that may not have been kicked into AMT in the past. I think we had a question Chris had referenced about charitable giving. Hopefully we'll cover that here. If not, jump back in and ask again. The 60% AGI limit was made permanent. That is related to cash gifts, so non-cash gifts are not included here. It was set to revert to 50% pre-OBBA, so that's a good thing. The floor basically just means that the first 0.5% of your AGI is going to be basically, in charitable contributions won't count towards your deduction. So this floor is new. It starts in 2026 and it just applies to itemized charitable deductions. But in other words, the deductions, only the total charitable contributions that exceed 0.5% of your AGI are going to be deducted. So something to consider here would be to front load or bunch those contributions in 2025 before this kicks in for 2026. And just basic example here is taxpayer with $1 million AGI. Basically, the first $5,000 of their charitable contributions is non-deductible. At 37%, this translates to a little over $1,800 in a lost tax benefit there. I think this is probably going to answer the question from earlier. So related to non-itemizers, there's a new benefit in 2026 that kicks in. It's a limited below the line deduction that's available. It would be $1,000 for single filers and $2,000 for joint. And again, this is just for cash contributions, not those non-cash contributions to Goodwill or some of those other organizations.
One thing to add here, Blair, and this does not apply to all taxpayers, but qualified charitable distributions from an IRA, traditional IRA. To qualify, a taxpayer has to be 70.5 years old to make a qualified charitable distributions. But I think now, even more so as we move into 2026, when we have this AGI floor, limiting those contributions that would otherwise be deductible. And two, with the very large standard deduction, if you're 70.5, I would say in most cases, the most beneficial way to give to charity and create the greatest tax benefit is by making qualified charitable distributions from your IRA. And we'll talk about how that can benefit you in other respects as well too. But just know that a taxpayer for the current year, 2025, could do a qualified charitable distribution from your IRA of up to $108,000. And for 2026, that amount adjust for inflation to $113,000. And that will help for those taxpayers that have really large IRAs. It will help for the future as well, because that's depressing the value of the IRA and could reduce the required minimum distribution that you may face either at the age of 73 or 75. So just keep that in mind as well.
Great point, Ryan. Moving on to talk about the PEAS limitation that was permanently repealed, which was a good thing, but in its place, we have a new 2% cap. And it basically is going to limit the overall tax benefit of itemized deductions to 35% for those that are in that higher 37% marginal tax bracket. The cap is based on taxable income, but this essentially means the value of allowable itemized deductions is limited to 35 cents of every dollar for those folks in that high tax bracket. A strategy here, and we've mentioned it before, and it's kind of a common theme, would be to accelerate those itemized deductions into 2025 so you can maximize that benefit before this kicks in. But let's talk through a pretty basic example. This is a really busy slide, I know, but there were a lot of details we needed to throw in there. So just stay with me. We've got some joint filers, 37% tax bracket. They have $800,000 in taxable income, $200,000 for itemized deductions. Before OB3A, they would have deducted the full $200,000. That benefit would have been the $74,000 at the top tax bracket, okay? Under the new law, which is effective in 26, itemized deductions would be reduced by 2/37 of the lesser of the total itemized deductions, which is that $200,000 for our example, or the amount that the taxable income plus adding back those itemized deductions exceeds the 37% bracket threshold. And that is the $751,600. So they exceed that threshold by 248,400. So for the purpose of this calculation, we're using the lower of the 200,000, which is their actual itemized deductions. So you'd take the 200,000, you'd reduce it by 2/37, which is 10,800. So at the end of the day, you end with a deduction of 189.2 in comparison to pre-OB3A, which would have been the 200,000. So you lose about $4,000 here in a tax benefit. But again, let me know, there's no impact here unless you have a top earner that's in that 37% marginal bracket. Moving on to QBI, I know that probably the business session a little later today will cover this more in depth, but because obviously flow-through entities, sole proprietors, all of that impacts an individual on their return as well, we need to speak to that too. You'll remember that the qualified business deduction applies to sole proprietors, partnerships, S corps. So think any flow-through entities, disregarded entities. This was done somewhat to level the playing field for pass-through entities when the corporate rate was reduced to 21%. The thresholds are increasing. There's higher income limits in 2026. So you'll see that. Initially, the House did propose a 23% deduction here, but the Senate kept the 20% in place. The increase to the phase-out income range is going to allow some more of those higher earning service businesses. So the specified service trader businesses, think law, accounting, health, those professions. It'll allow more of those to qualify for a partial deduction before it's fully phased out. There's also a new inflation-adjusted minimum deduction of $400 for active business owners that have at least $1,000 in qualified business income.
Blair, I think one good point here as well, you mentioned the specified service trades or businesses. And those taxpayers that have that type of character of income when it comes to the qualified business income, they're subject to phase outs at much lower amounts. And one of the great things that this does, with this now being permanent, is it allows obviously some greater certainty and a longer time horizon for planning, implementing some real sound plans. So one of those things that you can do, and this is, obviously something that you want to talk about with your tax advisor, but with the higher gifting exemptions now and estate exemptions, and with the permanency of this QBI deduction, there's ways where you can transfer ownership to another individual. Maybe you're transferring ownership down to, the next generation. And by doing that, now you've reduced the amount of income that may be subject to that phase in, phase out. So simply by transferring ownership, which may be part of your plan already, passing the business on to the next generation, could be a great planning opportunity for you to really maximize the QBI deduction.
Great point.
So I think that
we
takes us to the next poll.
Yeah.
Yep. Thanks, guys. Next polling question, what is the adjusted gross income or AGI percentage limitation for cash contributions to public charities? Is it 20%, 60%, 50%, or 30%? And while people have a few moments to reply to that, Ryan, we had a question for you. You mentioned how tax rates and the net investment income tax, how that planning can potentially be highlighted when someone is selling their business. Can you restate your comment there? Someone was interested in hearing that again.
Yeah, so where you have a pass-through business, so think about an S corporation, a partnership, where I've materially participated in that activity. So I'm involved in the day-to-day management of that company. Where I sell that business, it can be excluded from entering into the net investment income category. Generally, gains on the sale of a passive activity are going to be subject to net investment income tax, that additional 3.8. But the idea is where I've been non-passive and materially participating, it's not an investment per se. It's been my trader business, something that I've actively participated in. So that 3.8% would not qualify. And you can imagine in the context of the sale of a company, it could amount to a significant amount of tax. The good thing is, if you've sold a business and if you've experienced that and it wasn't caught, you can go back and amend returns as long as it's within the statute period.
Yeah, Ryan, something to add, just a real life story. You'll have a client for life when you catch something like that. But I have a client that went through a transaction and it was a large sum of money. And his prior CPA had subjected the gain to the 3.8%. And we were able to amend that return and get a pretty hefty refund back. So that's just always something to be looking for. Very good point, Ryan.
Thanks, guys. Let's look at those poll results now. 69% of the attendees say the limitation is 60%. I believe that's what we're looking for, folks.
That's right. It was set to revert to 50% under the TCJA after those provisions expired, but it is 60% going forward. They're still listening to us, Ryan.
Excuse me. That takes us into some of the new temporary changes and new benefits from the OB3 bill. This first one that we're going to talk about is, well, it's been a hot topic since 2017. So with the passage of the Tax Cuts and Jobs Act, the SALT deduction was limited to $10,000. So when we say SALT refers to state and local tax, which includes sales tax, income taxes, property taxes. But one of the biggest items where it's come into discussion has been real estate taxes. And this has been predominantly true for those clients that are living up in the Northeast, out west, very high taxing jurisdictions. This is a great piece of legislation that was passed to provide some relief to those taxpayers in that situation. With this new deduction cap, taxpayers will be eligible, both single filers, married filing joint, will be eligible for a deduction up to $40,000. And again, that's a significant increase from what we previously saw at $10,000. One thing to keep in mind, this is effective for tax year 2025 as well. So it's a retroactive provision that will allow us to take this deduction in 25. You will see on this slide that it is temporary. So at the end of 2029, this higher deduction cap of $40,000 will revert to $10,000 where it was previously. The $40,000 cap will increase. It's a nominal adjustment, 1% annually. One thing to note, and we'll jump into this in the next slide, is of course, with any of these new tax benefits, it's often tied to some income limitations. So we saw the same theme here on the SALT cap deduction, where it's really focused to those taxpayers that have gross income, modified adjusted gross income of less than $600,000. It begins to phase out at $500,000, but once you hit that $600,000 mark, either single or married filing joint, you phased out of that $40,000 deduction. Now, that does not mean to say that you lose it altogether. You will still be entitled to the $10,000 deduction, but you will be subject to that phase out.
Ryan, something to kind of note here is this really highlights the importance of planning opportunities around the pass-through entity tax election. So that's basically an election pass-through entities can make that involves making the election at the state level, but they would deduct the taxes at the entity level, pay the taxes, deduct at the entity level, and then different states treat this differently. For Mississippi, for instance, there's a credit for those taxes paid that passes through to the owner, but you're getting a federal deduction there. Whereas, you know, from the individual level, if you were paying those taxes on the individual side based on the pass-through income, you would have that SALT cap. Even though it's going up, you would still have that cap. So something to plan for here is maybe to look into the PTE election. There's a lot of rules for different states that go way beyond the scope of today's discussion, but it's definitely a planning tool to keep in mind here.
It's a great point, Blair. And, you know, just as Blair was mentioning when we were talking about charitable giving and the concept of bunching deductions, the same is true here. Based on your jurisdiction where you reside, some jurisdictions will allow you to pay 2 years of real estate taxes in 1 year. So if you're not hitting that $40,000 cap by just having 1 years of taxes, maybe it's a higher income year where you're at a higher tax bracket. Maybe consider bunching even real estate taxes as well.
Great point.
All right, so that takes us into some new individual benefits. Again, these are all temporary, so they will sunset at a certain point in time. What is common about all three of these new individual benefits: enhanced deduction for seniors, those that are age 65 or older, the car loan interest deduction, and the tax break on tips and overtime. Common amongst all three is that these are deductions above the line where you can be a non-itemizer or an itemizer. So whichever category you are in, you still may be eligible for this additional deduction. So it's a great benefit. And we'll talk about each of these in more detail as we move along. So the first one is the enhanced deduction for seniors. So you may have heard from the current administration on the campaign trail that there was a goal to eliminate the tax on Social Security benefits. Well, the ability to not tax Social Security benefits did not make its way into the OB3 bill. But I believe this was the solution that would allow certain taxpayers to have Social Security benefits not taxed or taxed at a lower rate. Perhaps instead of being taxed at 85%, they're taxed at a lower rate. Again, remember, this is on top of the standard deduction. So where I have a married filing joint couple, 65 or older, their standard deduction alone is $34,700. If they're within the income limitations, they're going to get a full $12,000 deduction on top of that standard, which will give them a total of $46,700 in deductions. So again, you'll see with many taxpayers where their sources of income are Social Security and maybe qualified retirement accounts, more or less fixed income streams. This is going to be the solution that allows a lot of those taxpayers to see a much lower level of their Social Security benefits taxed.
Yeah, Ryan, just to give a little more detail to that, you mentioned earlier those with R&D could consider the qualified charitable distribution to charity, which is a great opportunity for giving, but it's also a planning opportunity, to your point, to bring down that AGI, which could increase this allowable enhanced deduction and make less of that, the fixed income, that Social Security income taxable.
Yeah, that's a great point. And we've already seen the power of it. We were doing a planning exercise with a client just the other day, and they give to charity regularly. And we said, well, hey, we have this new enhanced senior deduction. They still had some additional charitable giving to do before the end of the year. And this was even more reason to do the qualified charitable distribution, because it pushed your AGI down and the enhanced senior deduction went up. So it's a great, great point that you bring up, Blair. Thank you. So the next item that we're going to talk about is the car loan interest deduction. And again, this is completely new. I don't know that this came about for this reason, but what we'll see in some future slides is that there was a tax credit eliminated on the sale of electric vehicles. And with that, you can obviously think that, some of the those in the automobile industry, those companies, were probably a little taken back that may have an impact on the sales of automobiles. So I don't know if the two are correlated, but regardless, this is a great new benefit for taxpayers. Again, it's tied to adjusted gross income limitations. You'll see in the slide there that it begins phasing out for single individuals at $100,000 and for joint taxpayers at $200,000. But essentially what this allows you to do is for a new vehicle purchase. And again, I emphasize that it's new. It's not on a used vehicle. On a new vehicle purchase with a loan that originated after 2024, taxpayers will be eligible up to a maximum $10,000 above the line deduction. Now, just like we saw with electronic vehicle credits, there are a lot of provisions tied to this piece of legislation that require assembly in the US. We saw that with the EVs, that there was a lot more emphasis that we want the production to be in the US. So you will have that requirement. And just like we saw with the EVs, these dealers are likely going to be required to provide information to the IRS on qualifying vehicles, and that may be providing vehicle identification numbers, etc. Note there that lease payments do not qualify, and we noted that the loan has to originate after 2024, but this would also qualify for refinanced loans that originated after 2024. So this is going to be a great tax friendly benefit to many of our clients going forward. Next on our list is tips and overtime tax breaks. Again, think this was pretty hot on the campaign trail for the current administration, and it came to fruition to some extent. Of course, there are caps. So on the new tip income deduction, there is a cap of $25,000. Again, subject to phase outs. But the thing that's interesting on these phase outs is they're much larger than what we see for other similar tax breaks. For example, on both the tips and overtime, the phase out for a married filing joint is between $300,000 and $550,000. So I think we're going to see an expanded segment of our taxpayer base that will be eligible for this deduction. Similarly, the overtime tax break, you can qualify for a maximum annual deduction of $12,500. Now, what you have to keep in mind here is for someone receiving overtime, it's not all the pay over and above the 40 hours. It's only the extra half pay component that is eligible for the deduction. But in both of these situations, for someone in the 24% income tax bracket that's getting to take a $25,000 deduction from their tips, they're going to yield a $6,000 tax savings. And similarly, on the overtime tax break, a similar situation, 24% tax bracket, we're going to see a $3,000 tax break. So for many of our clients, that's meaningful tax savings. So I think we'll see a lot of that going forward. One thing to keep in mind here, when we think of tips, I think it's common for us to think hospitality industry, servers, restaurants. But this goes well beyond the scope of just servers. You think of those salons, I mean, there's a multitude of things. So don't be afraid to ask your tax advisor, do I qualify for this additional tax deduction? Because again, that segment of those qualifying is pretty broad. So think of that.
Yeah, and something to note here, Ryan, is we don't really know what this is going to look like for the 2025 tax year in terms of reporting to you, those folks that may have that overtime and the tips. So we do believe that employers will have to track this and somehow separately report the qualified overtime to employees to help you get your arms around, what those numbers are going to look like to be able to calculate the deduction, because the forms are not intended to change until 2026. I know, Ryan, you're going to talk a little bit more about that, but just something to keep in mind.
Yeah, no, that's a great point. So, anytime you have new tax law, it's very often the case that additional guidance follows, and it may not follow immediately. And that's a good point that Blair brings up, because I actually just saw a notice from the IRS 2 weeks ago, I believe it was, where they are providing transitional relief. So for those of you that do have to provide this information to employers, or maybe you're self-employed and you're going to have some additional reporting requirements. The good thing is that the IRS has provided transitional relief where you will not be subject to penalties for the 2025 tax year for that information reporting. And this next slide here, it's just a draft form. The IRS has not finalized it yet, but you will see new boxes to report these tips and overtime eligible compensation pieces that will be eligible for the deduction. They will also be including on the W-2 and 1099s, like a specific code to identify that employee and if they qualify under one of these various industry segments. And now we're going to get into the credit expansion. Blair?
Yeah, thanks, Ryan. We'll first look at expansion of the child tax credit and some of the other family benefits. So the increased child tax credit, basically that's $2,200 per qualifying child. There'll be some annual inflation adjustments there. Just want to note that that tax credit change begins in 2025. The income thresholds are going to stay at 200,000 for single filers and 400 for married filing joint. That phase out for joint filers is from 400,000 to 444,000 before it's fully phased out, and from 200,000 to 244 for single filers. There is some enhanced refundability. $1,700 is the refundable portion, and that is made permanent for 2025 and beyond. So that's a good thing. The other dependent credit, you'll see that it was made permanent. It's been around for a few years, $500 credit for other dependents. The child and dependent care credit, these changes begin in 2026 related to this credit. The max credit was raised from 35% to 50% of those expenses. And the expenses did remain unchanged. There was some back and forth on increasing that amount, but they stayed at $3,000 for one dependent and up to $6,000 for two or more children or dependents. But the phase out rate was raised substantially here, so that's a good thing. A couple of other family-based benefit expansions related to the increase in the adoption credit and allowing some of it to be refundable, as well as the DCAP contribution limit was increased. So the adoption credit was permanently increased to $17,670 for 2026. That's $17,280 in 25. And up to $5,120 of that in 2026 will be refundable, $5,025. And then the dependent care assistance program, the annual pre-tax contribution increased to $7,500 for those joint filers and $3,750 for single. That begins in 2026. And this is just essentially a flex spending account for qualified childcare, for daycare, after school care, et cetera. The money set aside before taxes, just like with your medical flex spending accounts.
And I think the only quick point to note here, because the child care tax credit, because the income phase outs were increased substantially, you may find yourself analyzing what is better for me as a taxpayer now. Is it this dependent care flexible spending account, which may also have limitations if you're a highly compensated employee, and just comparing what is the optimal benefit? Because I think before, when we had lower income phase outs, we just didn't see the benefit. So it was better to go into the FSA. But going forward, I think, it will be important for you to do a deeper analysis of that with your tax advisor.
Absolutely. Looking at a couple of other credits that were expanded, there's a scholarship granting organization. This is actually a new credit of up to $1,700 for contributions to tax exempt orgs that provide K through 12 scholarships to lower income students. That kicks in 2027. The law also permanently extends the penalty-free rollover from a 529 plan to an ABLE account, and it permanently increases the contribution limit for ABLE account beneficiaries. So quick reference, an ABLE account, they're tax advantage investment and savings accounts for eligible people with disabilities. They do offer tax-free growth on investments in the account for federal purposes, and then you withdraw the money tax-free as long as the funds are used for qualified disability-related expenses. Something to note, there is no federal deduction for those contributions to the account, but an account owner who's employed with lower income may be able to claim a federal retirement savings contribution credit, which we call the Savers credit. Something to consider there. Ryan, I'm going to flip it over to you to talk some more about some of the credits that we see going away.
All right. Thanks, Blair. Well, with the good comes the bad. And some of the credits that we see expiring in 2025. In fact, all four of these credits that we're talking about will be expired as of 12/31/25. The EV credit that I already mentioned previously, that and the previously owned vehicle credit, these are two pieces of the energy improvement or efficient type credits that actually terminated as of September 30th, 2025. So if that new car was not purchased by that point in time, those EV credits are gone. One thing to keep in mind here, and I should have referenced it when we were talking about the different income tax brackets, but there are certain credits that are available to taxpayers where if you're filing married filing joint, you may phase out of it altogether. So there are situations and credits that will allow you to still file married filing separate. Maybe there's disproportionate income earned between taxpayer and spouse. So just keep that in mind. And I know that to be true because we did it last year and it was a great tax savings to our clients. The energy efficient home improvement credit, again, this will be gone as of 12/31/25. Think of this credit as windows, doors, HVAC units. The maximum available credit was $3,200 when you combined it. There was a category one and category two type within this. So the maximum credit was $3,200. So just make sure here, if you are making those energy home improvements, make sure that whatever it is that you're improving is installed and in service by the end of the year. Because it's not good enough with the IRS that you just pay the money within 2025. They actually require that it be installed and in service. And the same is true on the residential clean energy credit, which expires at 12/31/25. When you think of this credit, I want you to think of solar credit, the 30% solar tax credit. That was probably one of the more meaningful and impactful pieces in the energy credit segment. And again, just be mindful if you have an ongoing project, get on your contractor now and make sure the job gets done by the end of the year. And that takes us to our third polling question, Chris.
Okay, thanks, Ryan. Third polling question, by what date would you have to have acquired a qualifying electric vehicle to potentially benefit from the new clean vehicle credit? Is it 12/31/24, 12/31/25, 12/31/26, or 9/30/25? Running a little bit short on time, so please get those polling answers in as soon as possible. In the meantime, we've had a couple of questions come in about that enhanced senior credit, specifically around if one person in the married couple is above age 65, the other one is not, could they still benefit from that enhanced credit?
Yes.
Go ahead,
Absolutely.
Blair.
That's based on the taxpayer's age. So that could be the taxpayer or the spouse. It's $6,000 for each. So if one is above, it's $6,000, even if the other is not at that age. So it's dependent based on the taxpayer's age.
Yeah, perfect. Okay, let's look at those poll results. 57% said 9/30/25, 30% said 12/31/25. Ryan, can you clarify that for folks?
Certainly. So for those that answered 9/30/2025, you are correct. The four energy credits that are expiring are two vehicle credits and two more or less home energy improvement credits. The home energy improvement credits are expiring at 12/31/25. The vehicles were at 9/30/25. All right, so that's going to take us into our next segment on estate and gift tax. And this has been a hot topic of discussion. Obviously, most of us are probably aware that this estate exemption that we've been living under from the Tax Cuts and Jobs Act was set to expire at the end of 2025, where we're currently at a $13.99 million exemption. At the end of 25, it was set to revert back to $7.2 million indexed for inflation, roughly. So a lot of clients were working with your professionals, attorneys, to create estate plans that would satisfy or would allow you to hopefully minimize an estate tax burden. So with the passage of the OB3 bill, we now have a permanent $15 million exemption, and it will be adjusted annually for inflation. Now, again, remember, permanent is a relative term. So I don't think that it is wise to just turn a blind eye. I think that taxpayers that are in this situation where they have accumulated this level of wealth it's still very much important to revisit your estate plans. And Blair, I think you wanted to add something on that.
Yeah, I can't stress enough how important it is to go back and review those estate plans and maybe even consider simplifying any complex structures that were created under the lower prior exemptions that could produce some unintended results with these new numbers, the higher exemption. For instance, in wills and trust, a lot of those wills and trusts contain funding formulas that are tied to exemption amounts. And at the time that that was put in place, it was assumed that those amounts would decrease drastically in 2026. With that not being the case, those all need to be revisited. And this is not to say that advanced strategies are a thing of the past. We all know, as Brian has said it 2 or 3 times, permanent in the tax world is never really permanent. So those individuals with estates that are well above the current exemption continue to implement some of those strategies, but maybe take this as an opportunity to explore more flexible approaches there.
Thanks, Blair. So next, we're just going to expand on some other topics in the estate and gift tax world, and one of those being portability. So portability is a concept where I'm a married taxpayer, so 2 spouses, and at the first spouse's death, that spouse may have an exemption. We're just going to use round numbers. And let's say my first spouse had an exemption remaining at their death of $15 million. What portability allows you to do is to utilize or transfer over that remaining unused exemption from your deceased spouse. And this was especially important when we thought that the exemption amount was coming back to 7.2 million. We had a lot of clients that were looking where maybe their tax situation at the current time, from an estate tax perspective, did not look like it was going to be impacted. But once that sunsetting provision of the exemption came back down in 2026, there could be some real issues. So the good thing here is portability remains intact. Even though we have the higher exemptions, there is going to be a time and place for it. The good thing is that when you do port over this exemption, the IRS has said that they will not claw back any amounts that were obtained through a portability provision. So even in the future, if this permanent exemption amount of 15 million is stricken from law, so the next administration comes in and they say, no, we're going to pull it back to 7 million. If you have taken the portability from your prior spouse at 15 million, and you have filed a return to obtain that benefit, you will be able to keep it. And that's, of course, on top of whatever remaining exemption that you have at the time of your passing. One of the cool components with portability, it requires that you file an estate tax return, a Form 706. And in some cases, it can be a costly filing. There's a lot of disclosure requirements. But one thing is that the IRS allows you up to 5 years to elect to file portability. So if my estate by itself did not have a filing requirement because my gross assets were not over the exemption amount, I don't have to file a return. So what the IRS has allowed is anytime within 5 years from the decedent's date of death, the personal representative or executor for that estate can still elect to file that return to preserve that portability. So keep that in mind. On the annual gift tax exclusion side, there were really no changes here. It, of course, will be indexed for inflation each year. I think one of the biggest planning components here is, for those clients, those individuals and taxpayers that have accumulated a higher amount of wealth that still want to do some proactive estate planning, I think the annual gift exclusion is still one of the easiest ways to shift assets outside of your estate. And that's especially true for grandparents that have grandchildren. So there's a concept called superfunding, and the superfunding is to a 529 plan. That's like a qualified education account that allows you to put monies into an account for a beneficiary for their future education needs. And what this allows you to do, the superfunding of a 529, is to make a contribution of essentially $95,000 in year one for one grandchild without utilizing any of your lifetime exemption amount. Because what it allows you to do is to treat that $19,000 that you would have received over the next 5 years as being allowed in year one when you make the contribution. So you think of someone that has 10 grandchildren and they want to fund their educations. That person could transfer $950,000 outside of their estate without using any lifetime gifting exemption. So it's just a great benefit and one that I think goes unseen too often. So keep that in mind, especially of those of you with grandchildren. I think we already touched on the sunsetting, so we're not going to talk back to that. Again, it's permanent until there's a change in tax law. And the federal tax rates for GST, which is generation skipping transfer tax, gift tax, and estate tax, it remains at a maximum rate of 40%. And I think that takes us to polling question number 4, Chris.
Thanks, Ryan. Final polling question of the day. How long after a decedent's death does an executor have to file an estate tax return for portability? Is it 9 months, 24 months, 15 months, or 60 months? Again, I appreciate everyone's quick response to these polling questions as we are running up to top of the hour. We did have a few questions come in specific to the new tax credit for scholarship granting organizations. Could we expand a little bit on what a scholarship granting organization is for folks?
Sure. States are actually going to have to opt into this program, and they're going to have to determine which organizations qualify as SGOs, so that taxpayers could pay into those organizations and receive credits related to that. But there is no phase out for that. So that's a good thing. And no sunset for that as of now. So it is permanent. But yeah, again, that'll be determined at the state level, which organizations qualify for that.
Yeah. Thanks, Blair. And generally, those organizations will be set up to provide scholarships to K through 12 students, typically for private schools. But as Blair said, the states will administer which charities qualify. With that, let's look at those poll results. 46% said 60 months. Ryan, I think that's what you were looking for there.
That is true, Chris. The majority hit it on the head. 60 months. All right. So if no other questions at this time, we're going to get into key takeaways and planning opportunities. Blair?
Yep. I want to be respectful of your time. I know we're running short on time, but just high level, the main takeaways for you guys: TCJA tax cuts permanent. That SALT cap increases to 40,000. Higher standard deductions were made permanent. That charitable giving floor, the 0.5%, begins in 2026. There's the new itemized deduction limit for higher earners, and Ryan has talked about the estate exemption permanently being increased to 15 million. With all of this, you have opportunities for planning. A few of those: think Roth conversion strategy. Consider Roth conversions while you're in that lower permanent tax bracket to go ahead and lock in long-term tax-free growth. Pay the tax now, don't pay it when you draw out later after converted. Accelerate donations into 2025 to maximize those donations on the charitable giving side before that limit takes effect, the floor. And remember the lifetime gifting strategy. Use those expanded lifetime gift exemptions to shelter appreciating assets from that future estate tax. Something I do want to say here is, the old tried and true, accelerate deductions, defer income is in place here, coupled with a lot of the planning that we've talked and some of the changes through OB3A. So keep that in mind over the next few weeks. It is doubtful that any additional legislation is going to be pushed through by year end. But I think with the government shutdown still in place, there's potential that any deal struck to open the government back up could include some minor tax legislation. Although there's nothing out there in the pending deal to reopen the government currently, the deal does not include anything about the expansion of the premium tax credit for ACA health plans. That was all part of COVID-19 legislation, and it's set to expire at the end of the year. So, the extension of this credit has been stated as a goal of the Senate Democrats in holding out on voting for a budget bill to open the government. On the flip side of that, some Republicans have even talked about the possibility of another reconciliation bill, which only requires a simple majority to pass. Interestingly enough, it's how OB3A was passed in July. The rules around what can be passed in a reconciliation bill are pretty strict, but tax changes are allowed. I say all that to say we don't really know the true interest of a reconciliation bill on Capitol Hill or at the White House. So the likelihood of any of this happening before year end and everybody being on the same page is pretty low, but that's just something to keep in mind.
Excellent context, Blair. And again, I think as we wrap this up, I think anytime you have major tax overhaul like this, it's best to just plan a meeting. Sit down with all your trusted advisors. And what we find is often the best, efficiency is sitting down with your CPA, your attorney, your financial advisor, and making sure that all three of those individuals are working towards your goal. But again, anytime you have major tax overhaul like this, it just creates a lot of great planning opportunities. So we'll look forward to meeting with you as we approach the year end and moving into 2026. And we thank you all so much for your time and spending this time with us this morning.
Absolutely. Thanks.
Yep. Thank you, Ryan. Thank you, Blair, and thank you everyone for attending. I do want to plug for any future tax updates. Please connect with CRI on social media or on all the social media platforms. So be sure to connect with us so that you can get any of our updates as they come out. Unfortunately, we are over time, so we don't have time for any more of the great questions that have come in. I do encourage you to reach out to your CRI advisor, get those questions answered. They'd be happy to sit down with you and discuss your specific tax situation.
And
So
if
with
you don't
that-
have a CRI advisor, reach out to Ryan or myself or Chris. We'll be happy to talk to you.
Absolutely. So with that, I will wrap it up here. Thank you everyone for attending.
Thanks, everyone.
Thanks, everyone.